Okay, good evening everyone. I'm CA Rekha Panchwani and I'm honored to be your moderator for this webinar. Just to inform you all that my camera is not functioning at the moment, I appreciate your understanding. We are delighted to welcome you all to this session organized by the Committee on Commercial Law, Economic Advisory and NPO Committee of ICI. It is my pleasure to be moderate today's editions of the Know Your Law series 96th webinar on the topic AML CFT risk assessment and use of a risk-based approach for professionals. This webinar is being organized by the CCLEA and NPO Committee of ICI, which is committed to promoting knowledge and creating impactful opportunities for chartered accountants. Before we begin, allow me to briefly introduce the committee. The CCLEA and NPO committee empower chartered accountant to contribute meaningful to strategy and policy that enhance economic, financial and social outcome. It focuses on sharpening knowledge and technical guidance, supporting policy formulation and creating awareness about emerging professional opportunity in commercial law, economic advisory and the NPO sector. Today's speaker will shed light on AML CFT risk assessment and the importance of adopting a risk based approach for professionals. We are confident this session will be insightful and beneficial for all participants. Already 100 plus participants have been joined. Okay, now it is my privilege to introduce Mr. Samrak Sween, Director of the FATF cell under the Department of Revenue, Ministry of Finance, a seasoned Indian Revenue Service officer with over 15 years of experience. Mr. Sween is a national expert in anti-money laundering and countering the financing of terrorism, commonly known as AML CFT. He is currently leading India's National Risk Assessment 2025, a landmark initiative to assess and mitigate threats related to money laundering and terrorist financing. He also played a vital role as deputy head of India's delegation to the Financial Action Task Force, successfully steering the country through its 23-24 mutual evaluation, where India earned the prestigious regular follow-up status. His international engagements span across capacity building efforts in Sri Lanka, Myanmar, and the BIMSTEC region, along with a major strategic initiative like the National Registry of Beneficial Ownership. Beyond his policy and operational work, Mr. Swain is also an accomplished author with a title like Digital Fortunes, published by Bloomsbury in 2024 and Loophole Games 2018 to his name. We are honored to have him with us today. With that, now I invite Mr. Swain to kindly join us and share his valuable insight with the audience. Sir?
Namaskar, and a very good afternoon to all the participants of this webinar. And thank you, CA Rekha, for the kind words. I again want to thank CA Abhay Chahal and CA Pramod Jain for making this possible, and also CA Rekha Panjwani for moderating the session. And I also want to thank my colleague and expert on AML CFT, Agam Sukla, who will be taking us through through this presentation, through the technical aspects of recommendation 22 and 23. But before he takes us through this presentation, I would like to give a very short introduction about what we are planning to do here, and why Department of Revenue, why we are partnering with ICAI in conducting this outreach session. The thing is that anti-money laundering, that is AML, and countering the financing of terrorism, that is CFT. AML CFT in the last many years has become a very important field when it comes to compliance. Whenever we go to bank, the bank asks for KYC. That the KYC that a bank asks, or the KYC that a stockbroker asks, all of this is part of AML CFT framework. So AML CFT compliance has become so widespread that it pervades many areas. So some of the areas that where AML safety compliance has to be implemented are basically banks, banking companies, NBFCs, stock brokerages, stock exchanges, virtual asset service providers, that is the crypto exchanges. Similarly, there's a group of non-financial businesses and professions on which AML CFT compliances are also applicable. These groups are usually called DNFBB, that is Designated Non-Financial Business and Professions. Among DNFBB, there are six categories which specifically FATF has identified. FATF is basically the global watchdog against money laundering and terrorist financing, and they provide us the international standards. Those are the minimum standards that countries have to implement in their country. Other than that, they can also implement FATF plus standards. Those are laws which countries themselves make depending on the risk that they face and the mitigating strategies that they have identified to follow. Now, these six categories that FATF has specifically given us, they're mentioned in recommendation 22 of FATF. I will not go into that because, of course, Agam is going to go into greater detail of that. One of these categories is professionals. Why it is so? It is so because over a period of time, the members of FATF and various countries and various international organizations, they have recognized and they have acknowledged that professionals are at a higher risk of being party to or of being observer to money laundering happening or terrorist financing happening. Okay, why? Because chartered accountants as professionals are some of the highest ranking professionals to whom customers, to whom clients refer to for advice on finance, for advice on monetary matters, and for advice on financial flows. In many offshore financial centers, chartered accountants are also actively involved in fund management and in movement of money on behalf of their clients. Because of these reasons, it has been decided to include chartered accountants as professionals within the AML safety framework and impose some AML safety compliance on them. Now you may think, okay, so this is a compliance that has been imposed on me. I have to follow this because the government wants us to follow this. That is not so. That is not so. Let me explain this matter right from the onset. Implementing AML safety compliance is ultimately useful for the professionals and for their business itself. It has been seen in many countries. It has been seen across financial institutions. I'll give you a very simple example. When the prospects of cybercrime increased in recent years, the last 3 or 4 years, the volume of cybercrime that has happened in different countries has increased manifold and exponentially. The interesting thing is that private banks, they are partnering with government agencies in setting up systems for immediately identifying scams that are happening and immediately freezing any money which is scam money. Why they're doing it? Because financial institutions do not want dirty money to go through their institutions. By preventing dirty money from going through their institutions, they're increasing the confidence among their clients that they are here to do business, to earn profits, to make money, and at the same time to provide the right kind of services to their clients. It also gives a lot of confidence to the clients. Yeah, in fact, for a financial institution, nothing is more important than, let's say, a high net worth client coming or a foreign client coming or an MNC client coming and saying that, okay, we understand that you have so robust controls, so robust AML safety controls, and that gives us a lot of confidence in doing business with you. Not only that, the shareholders, they also get a lot of confidence in these financial institutions or activities. Similar to that, in the case of professionals, when professionals have robust AML safety controls, they can actually boast about it. When ICI as a self-regulatory organization comes and regulates, comes and conducts on-sites or off-sites in your organization, and they find that your controls are really good, that is something that you can be proud about. That is something your industry will be proud about you. That will increase the confidence of your industry on you. That will increase the confidence of MNC clients on you. That will increase the confidence of government as a client on you. That will increase the confidence of even normal clients on you. That you are a person, you are a firm which is having very good AML safety controls. That is I mean, it is a situation. AML safety compliance is not about a one-way compliance. It is about developing an ecosystem of transparency. And when you develop such an ecosystem of transparency, when you are actively involved in AML safety, tomorrow if something happens, tomorrow if an investigation happens, the investigators will also acknowledge that you had your AML safety compliances, you have maintained very good compliance. In spite of that, something happened, which means that, which directly shows that as a professional, you have acted in the most ethical and in the most appropriate way. Uh, Now I'll come very briefly to what these compliances are, and after that I will hand over to Rekha Madam again. Now these are, broadly speaking, they are FATF talks about the understanding of risk and applying a risk-based approach. That is mentioned in recommendation 1, the first recommendation that talks about understanding of risk and applying a risk-based approach. FATF says that the understanding of risk has to be multi-tiered. First, on a national level, countries, I mean, it does not say explicitly, but this is the procedure that is followed based on the standards that are given in recommendation 1. At the top tier, we have the national risk assessment, which is conducted by the Department of Revenue in Finance Ministry. Okay. The national risk assessment as of today is a confidential document, but the findings of the national risk assessment, the entire national risk assessment is shared with the regulator, and the key findings are shared with all the reporting entities through a portal of through a secure portal of FIU India. Now, now this national risk assessment, which has been shared with the regulator, it is read and produced by the regulator, and regulator develops his understanding of risk based on the national risk assessment as well as their understanding of risk emanating from the sector. So we come to the second tier, that is the sectoral risk assessment. After the national risk assessment, the regulator conducts a sectoral risk assessment. Like, for example, in the banking sector, RBI conducts a sectoral risk assessment. In the insurance sector, IRDAI conducts a sectoral risk assessment. Similarly, in the for CA professionals, ICAI is in the process of conducting a sectoral risk assessment. Now, this sectoral risk assessment is confidentially shared by ICAI with its members or with its reporting entities. Now we come to the third tier. The third tier is called IRA, or institutional risk assessment. An institutional risk assessment is something that you as a professional firm conduct. It may not be a very expensive one. It may not be a very very voluminous documentation, but it should demonstrate that you have a basic understanding of risk. You know where the risk emanates from. If the risk is from cell companies operating from such an XYZ country, you know that there's a risk emanating from XYZ country. If there's a risk emanating from cybercrime call centers operating in Cambodia or Laos, you know that a risk. If there's a risk arising from cell companies and the kind of and the ways in which cell companies can be misused, you do understand the risk. If there's a risk arising from specific offshore finance centers, I won't take names, but let's say Dubai. I mean, without taking names, I would like to say just illustratively, let's say there's a risk emanating from Dubai or from Singapore or from some Mauritius. It is something that you are aware of. That is the only requirement from a CA firm. They have a proper understanding of risk. Okay. Now, why do we need an understanding of risk? We are developing an understanding of risk in 3 tiers: NRA, SRA, and then IRA at the level of chartered accountants. Why do we need this understanding of risk? So that we can follow a risk-based approach. Why do we need to follow a risk-based approach? That is the next question and last question. The answer to this is we need to follow a risk-based approach because we do not want our business, our profession to be affected. Ultimately, we are in the profession to make some profits, to do some activity, and at the same time to make some profits to make a livelihood, right? Okay. We want our business or our profession to go on seamlessly. We also do not want too much of documentation which will overwhelm a customer or a client. Okay, we want to ensure that if there's a low risk client, if there's a client who is coming, you know him very well, he's a low risk client, we take minimal documentation from them. We take very minimum KYC from them. Okay, if there's a client who is coming on whom you do not know the risk level, you take some basic plus documentation from them. But if there's a client who is coming and you suspect that, and I'm not suspect, and you think that they present high risk depending on your understanding of risk, then you do an enhanced due diligence, which means that you ask them for more and more documentation so as to understand who they are and what they are doing and why they want to do so and so activities. and this will act as a guardrail to ensure that those who come to you to let's say open companies or to get their accounts audited, uh, they are saying what is actually true in their case. Okay, they are not saying something just to fool you. Okay, just to put your professional degree at jeopardy. And that's the reason why we follow a risk-based approach. You develop an understanding of risk based on customer risk, based on product risk, etc., based on country risk, etc. And then you categorize any new customer as low risk or medium risk or high risk. If it is low risk, then you take only one small documentation, take a PAN card or take an Aadhaar card. If it is medium risk, depending on the directions given by your institute. If it is a medium risk, then you take some more documentation depending on the directions given by your institute. If the risk level is high, if you find the customer to be risky, before onboarding the customer or after onboarding the customer, you may ask a lot of questions to them and collect a lot of documentation to satisfy yourself that yes, I'm satisfied about the identity of this person and what is the source of their funds or what is the intent of the for which they have come to me. And doing this much, maintaining this much of documentation actually helps you ward off any kind of too much of inquiries from your regulator or from enforcement agencies because you have done your part. So that is the benefit of following a risk-based approach principally. Now I will. I think I'm over. I only have to give an opening remark. Okay. So I will request Rekha Madam to again take over. Thank you.
Thank you so much, sir. I have so many doubts with respect to the things you said. Okay, we will just later on we will start the Q&A. Okay, thank you so much, sir, for your valuable insight. We truly appreciate your time and your knowledgeable things. Now I would like to call. Now I am pleased to welcome Mr. Agam Shukla, sir, a leading AML CFT expert currently serving as a legal consultant with the FATF cell, Department of Revenue, Ministry of Finance. He brings extensive experience in legal and financial regulatory framework with the key focus on policy development, legislative drafting, and India's compliance with the FATF standards. Mr. Shukla has played a significant role in critical initiatives such as the Mutual Evaluation Report and the upcoming National Risk Assessment, contributing to India's effort in combating money laundering and terrorist financing on a global scale. It's an honor to have with him as today. Sir.
Yes. Good evening to all esteemed members of ICI, and thank you, Rekha ma'am, to give me this opportunity to speak over here. It's really a privilege to be here among such a respected group of professionals to discuss an important topic of such a growing importance as key gatekeepers, professionals being key gatekeepers in the financial system. The role of professionals in identifying and managing risks, particularly in the context of AML CFT, is more critical than it was ever before. So today we will explore as to how to adopt a risk-based approach that aligns not just with international expectations, but also with the India's legal regulatory framework, which will not just be to meet the compliance requirements, but also to strengthen trust and integrity in the professional standards. So I look forward to our discussion and shared learning ahead. So I'll share a brief presentation of mine, which I would like to present, and through that I will impart the learnings whichever is required with respect to the topic which has been shared. So kindly confirm if my screen is visible.
Yes, sir.
Okay. So the topic which we are going to discuss today is AML CFT risk assessment and use of a risk-based approach for professionals, as deliberated by Smarak sir initially, that the role of professionals um, in safeguarding the AML CFT context is very critical. So coming to that, we will start with the big player, which is FATF, Financial Action Task Force, which is a global watchdog, which is established in 1989, and it has 39 member countries, which includes India as well. So the mandate of FATF is to combat money laundering, terrorist financing, and proliferation financing. So via its 40 recommendation and 11 immediate outcomes, FATF basically set standards which promotes and develop policies which protect global financial system. So some of the key recommendations which are applicable to professionals, which are DNFBPs, basically designated non-financial businesses and professions. So key recommendations applicable to professionals of FATF are recommendation 22 and 23. However, there are some other recommendations as well which feeds into these two recommendations, such as recommendation 10, which talks about customer due diligence, such recommendation 11, which talks about record keeping, recommendation 19, which talks about higher risk countries, recommendation 20, which talks about SGR reporting, and recommendation 28, which talks about supervision of DNFVPs. So in culmination, those recommendations will feed into these key recommendations which are applicable to professionals. In our case, accounting professionals. So recommendation 2 basically mandates customer due diligence uh, with respect to accounting professionals. For example, if a customer is dealing, so there are certain criteria which are provided in recommendation 22, and if a professional is undergoing activities, those activities on behalf of their client, then they have to undergo customer due diligence. Those activities which are mentioned in recommendation 22 are buying and selling of immovable properties, managing clients' money, assets, securities, etc., establishment, operation of companies on behalf of their client, etc. So these are certain activities. If a professional is going through on behalf of their client, then they have to be subjected to recommendation 22 obligation, which is doing customer due diligence. Now recommendation 23, again, once the professional is subjected to recommendation 22, they will also be subjected to recommendation 23, which talks about suspicion transaction reporting. So it will be an obligation on part of a professional, accounting professional, if it come across any suspicious activity or transaction undertaking anything on behalf of their client, then they have to report it to the regulator. Now we will come to the AML CFT framework which prevails in India. So we have Prevention of Money Laundering Act 2002. So it basically talks about the section 2 subsection 1 clause SA and subclause 6 provides the central government with power to designate any person as DNFBP. So pursuant to this particular provision and utilizing that power given in section 2 of PMLA, central government came up with notification of 2023, which provides for AML safety guidelines for professionals. Now, under this, company secretaries, chartered accountants, and cost working accountants obtaining certificate of practice are considered as DNFBPs. And there are certain criterias which align with recommendation 22 itself. So in for an example, if a accountant if an accountant professional is undergoing any of the following activities, such as buying and selling of immovable property, managing clients money, assets and securities, managing and creation and operating of the company on behalf of their client, and etc., and managing its legal persons and arrangements, so that person would be considered as DNFPB as per PMLA section 2. Now, what is the implication of professionals being designated as DNFBP? So they will have additional requirement, particularly in relation to India's regulatory framework such as PMLA, PMLR, and all other relevant guidelines and circulars would be applicable to them with respect to record keeping, with respect to due diligence, with respect to compliance, as well as the international standards set by FATF will also be applicable to them. So they will have some additional duties once being designated as DNFBPs. They will have some additional duties such as CDD, such as record keeping, such as SGR reporting, um, once they are designated as DNFBPs. Now, as told by Smarak sir, India is in the process of conducting national risk assessment, which will be a second national risk assessment for us, uh, continuing in this year itself. So previously, India had its national risk assessment in the year of 2022, wherein certain areas were highlighted as high risk. So one of the areas some of the areas in highlighted in the national risk assessment were real estate sector, intensive cash transactions, shell companies, and some of the professionals, especially indulged in company formation and asset management, were identified as very vulnerable. So we can say chartered accountants, company secretaries, cost working accountants were identified as a vulnerable sector. And one of the key issue which was highlighted in India's NRA 2022 was concealment of beneficial ownership, which eventually will come up as a red flag indicator as well while determining the risk assessment. So we'll come into that point, but particular point later on. So now, upcoming NRA, as I stated, the process is ongoing, and ICAI has also been informed to conduct its own sectoral risk assessment, which will eventually feed into the national risk assessment of the country, and key findings would be shared with um, relevant agencies and competent authorities, so that the mitigation strategy of the country uh, to cater the basically safeguard the MLTF risk should be very astute. Now, I will come into some of the risks which basically accounting professionals uh, predominantly face. So this is not an exhaustive list, but an inclusive list which will give you a bare idea as to what sort of risks which are faced by the professionals, especially accounting professionals. So risks related to creation of shell companies, risks related to politically exposed persons. So once if an accountant is dealing with politically exposed persons, that the risk quotient is comparatively high as compared to dealing with a normal profession. Then risk related to beneficial ownership, again, which is a critical issue as highlighted in NRA 2022. Risk related to legal persons and arrangements which have their complex structures, benami shareholdings, related party transaction, which manipulation of related party transaction, high risk countries which have weak AML jurisdictions and lower measures with respect to AML and CFT, unexplained income, and corporate restructuring being other risks. So now, once we have got a bare understanding as to what risks are being faced by the professionals, what should be the approach to counter those? So basically, risk-based approach, which is basically the key component being assessing, identifying, assessing, and understanding, as well as employing mitigating measures to curb the effect of ML and TF. So this is what risk-based approach is. So basically, if I would put it into very abject terms, risk-based approach is basically identifying, assessing, and understanding MLTF risk to which the accountants as professionals are exposed to, and to implement appropriate measures to effectively and efficiently mitigate MLTF and TF risk. The approach over here, the key point over here is the allocation of resources. So you cannot employ equivalent resources to each and every domain. The point over here is that if a particular customer or a client is low risk, you cannot employ the similar amount of resources over here as you will deploy in the case of a higher risk customer or a client. So basically, this is a dynamic approach which requires allocation of resources based on the risk quotient. Now, what are now there are certain critical components of risk-based approach, and you know the prerequisite for risk-based approach is risk assessment. So we will first come into the identification part. So how do we identify the risk? So as Smarak has stated, there is a multi-tiered approach which is followed, that is national risk assessment, then sectoral risk assessment, then institutional risk assessment. And key findings are shared with everyone, including competent authorities. So the sectoral risk assessment would include and obtain the information regarding the risks which are prevailing and which will come straightforward from national risk assessment which has been done. And once the sector has obtained the knowledge with respect to the risk prevailing, now an institution with respect to their variables such as clients which they are dealing with, such as services which they are providing, such as the geographical indications which they they are dealing with, they will base their own internal policies and control to curtail ML and TF. So this is the basically is the genesis of identification of risk. Now we'll go to the next part, which is assessing of risk. So over here, there would be a number of risks which will be identified by the NRA, but not every risk would be applicable or relevant would be relevant to the particular sector. For example, a particular risk could be relevant to banking sector, but not to accounting sector or accounting professionals. So assessment is basically to basically identify as to what risks would be relevant to my own sector. That is to say, accounting, like ICI would, once doing sectoral risk assessment, would identify what are the risks which would be relevant to their own sector. Now, coming to the third part, which is mitigation. Mitigation involves uh, basically deploying such steps and basically evolving such steps which would uh, give an efficient and effective management of mitigating those risks. So mitigation strategies could be applying customer due diligence, enhanced due diligence, conducting training and awareness programs for professionals so that they are aware of whatever risks are prevailing and how to counter them, then reviewing of the relationships between the clients and the professionals. So these could be some of the mitigating strategies which will be taken up by the professionals. Now we will come to the next slide, which is risk assessment. So it is a very known saying that the secret of getting ahead is to get started. So risk assessment is basically the first step in risk-based approach to get started. So this is the prerequisite in a risk-based approach to start off basically the procedure. So there are certain criterias or components or categories of risk assessment. So risk assessment is done on the basis of certain criteria, which are geographical risk. So basically you can say if a country, if a client is dealing in a country with higher AML CFT risk, for example, if it is a sanctioned country and you being a professional come across with a client who is dealing in such countries, so that client would become a higher risk client. However, if a client is based in the jurisdiction in which the accounting professional is also based, and it is a very viable jurisdiction with respect to AML CFT laws and have adequate controls, so this will be a lower risk category criteria for evaluating in the risk assessment. Then again, uh, one of the criteria could be delivery channels, transaction channels, or services which accounting professionals impart. Then one of the risk would be client risk. So some of the examples, if I could like just impart for in categorizing them as high risk and low risk is, so in the case of risk assessment, what you will do is, if you pick up one category such as client risk, now if you will see that the client is non-resident, the jurisdiction in which you are working, and the client is of different nationality, so then this in itself is a key red flag indicator as to categorize it, that particular client into high risk category, and as compared to a person or a client or a customer who resides in the country of your own jurisdiction. So, and if a client who engages into high cash incentive business transactions, so that in itself is a key red flag indicator to evaluate it as a high risk category person. Now, on the basis of these criterias, we categorize customers or clients in a spectrum which is low risk, medium risk, and high risk. So for low risk category customers, we will employ a bit of less stringent scrutiny. Basically, we will apply simplified due diligence measures, or some customer due diligence measures wherein we will not require additional information from him to be procured. However, in case of high risk category clients, there is a recommendation 10 which provides for enhanced due diligence measures which are to be employed in cases of high risk category clients and customers. So that's how we evaluate our clients on the basis of these risk components and variables. So again, in the case of low risk clients, we will do basic CDD. That is to say, we will ask them to procure some OVD, that could be any official ID, then basically obtaining purpose and nature of business and ownership control, and then we will initiate the transaction on behalf of the client. However, in case of high risk, for example, if it is a PEP, politically exposures, and will require multiple additional information such as sources of funds, sources of wealth, and will employ continuous monitoring of that particular transaction while taking care of the business activities or managing or initiating the transaction on behalf of the client. So some of the key risk-based approach components are CDD, clients of customer due diligence itself. So it is basically to identify the client and identify and understand the nature of service as to what client intends to do. Enhanced due diligence again is level of higher scrutiny which is employed in case of higher risk, um, and this is to basically justify, um, as a professional, to justify whether the client is undergoing a genuine activity or a legitimate activity or not. So the measures are comparatively stringent, and the information and all other obligations are very frequent, and very high intensification is done when we go through EDD process. Now, multiple other obligations are there with respect to accounting professionals, which are to be followed, which is record keeping, as stated in recommendation 11. So once they are designated as DNFPPs, so they have certain obligations. So one of them being record keeping. So whatever documents whatever information they obtain while doing the process of CDD and EDD, they have to document it, and they have to keep it for themselves in order to, like, if it is asked by the regulator or by the supervisor, then they have to like provide those documents to them. Then one of the obligation is STR reporting. Like once the accounting professional come across any of the activity which amounts to suspicious, then they have to promptly report it to the regulator. And ancillary obligation would be raising awareness, as it will be very much relevant for professionals to be very sound and very abject with respect to AML CFT compliance, and that comes through thorough training and like going through practical aspects of it. So like up, employing the risk-based approach, Smarak sir already told multiple benefits. It like elevates the integrity of the profession in itself. It builds customer trust. It helps in like promoting the financial integrity of India, which will eventually contribute to ease of doing business. Like foreign national and foreign investments will uh, flow along when we have adequate AML CFT controls. So like a risk-based approach is practically beneficial for accountants as professionals, and to promote the financial integrity and sanctity of the country. So all in all, basically, if I would say, professionals have very critical role in combating the ever-going menace of money laundering and terrorist financing. So once they are thorough, and they are very much knowledgeable about what approach to follow in order to uh, basically curtail the prevailing risks as well as emerging risks, they will they will not only benefit themselves by doing that, but also in a larger context would be contributing heavily towards financial uh, stability of the country. So I feel that's all I would like to provide with my presentation, and I'm happy to take up any questions if at all which comes up, and I would like to hand over to Rekha ma'am for further discussions. Rekha ma'am, you can take over. Uh, yes, yes. Uh, Rekha ma'am can take over. I have completed my presentation, and I would look forward to having any questions, if at all, from any of the participants.
Okay, Agam sir has finished his presentation. Now I would like to invite Swain sir to just continue the session. Sir.
Thank you, Rekha madam. I think this introduction was very important because so that we get to understand what are those recommendations, one and what they say. But more importantly, these recommendations have now been brought into the guidelines issued by FIU and also into the guidelines. Part of it has been brought into the guidelines issued by FIU, and part of it is will be implemented through the ICAI directly. Now, one thing is worth noting here. Recommendation 22 is applicable. I mean, the KYC requirements, they are applicable to all the chartered accountants or when they are onboarding any client or when they're dealing with a client. But recommendation 23, which is about STR filing, it is applicable only to specific chartered accountants. Who is it applicable to? It is applicable to only those chartered accountants which perform five different services, five specific services for or on behalf of their clients. Now, for those five specific services, when they perform those services for on behalf of their clients, when they conduct financial transactions on behalf of their clients, the number of chartered accountants who do that is not much. It will be only a limited number of chartered accountants, which probably ICI can tell you. ICI had conducted a survey in which they had found out the chartered accountants which conduct financial transactions for or on behalf of their clients. Only in their case, the question of filing STR will arise. And they will file STRs only when they find a suspicious transaction. If an alert is generated, then they'll find a suspicious transaction and STR will be filed. So recommendation 23 may not be valid for all the chartered accountants here. Okay. But recommendation 22 is valid for all the chartered accountants who are here. So KYC has to be done by all the chartered accountants whenever they onboard a client, whenever they engage in a relationship with a client with a customer, or at a time when some new project or a new product is also being tried out by the customer. Okay. So recommendation 22 does not require you to do any kind of STR filing. It only requires you to maintain KYC. That KYC has to be risk based. Okay. Now, if anyone has any questions, we are open to those questions. Any kind of questions that you may have with regard to recommendation 22 or 23 or any other recommendation that Agam spoke about. such as recommendation 6 and 7, recommendation 15, high risk jurisdictions, which is in recommendation 19, these ones, as well as recommendation 22 and 23. Rekha madam, I see that probably this is a webinar. So how do you take the questions here?
Sir, I will just read the questions, so you guys will answer it.
Okay.
So the question is, first the question is, what is the meaning of AML CFT risk assessment? I think it's a...
Okay, yeah. So the meaning of AML safety risk assessment is that you assess the risk that you assess the risk that is emanating from money laundering and terrorist financing to you. So the national risk assessment means a risk assessment that happens at a national level. Sectoral risk assessment means a risk assessment which is conducted at a sectoral level. And institutional risk assessment means the risk assessment that you are facing, the risk that you are facing. Now, risk assessment does not follow any standard methodology. It does not follow any specific methodology. What is risk? It is very simple. Risk consists of threat, what a threat, and vulnerabilities and consequences. Three things: threat, vulnerabilities, and their consequences. The understanding of threat, vulnerabilities, and consequences are all that you need. And if you can document that understanding, then that is basically a risk assessment. I'll give you a simple example. Let's say I'm running a single partner farm. We call it a proprietor, right? Let's say I'm running a proprietorship farm, CA farm in 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 Cuttack city of Odisha. Okay. What are the risks that I'm facing? Okay? So I'll divide it into three parts: threat, vulnerability, and consequences. Okay. Threat. I may not be. Let us start with terrorist financing threat. I may not be facing too much of terrorist financing threat from external parties. I may not be facing threat from left wing, Jammu and Kashmir extremism or Khalistani extremism or Islamic extremism, but I am facing threat from another theater, which is left-wing extremism. Left-wing extremism is active in western parts of Odisha and in some patches in southern parts of Odisha as well. Because of this, there is a threat of terrorist financing from left-wing extremism. Now, I need to understand how do these activities happen. In order to understand, I can go through the national risk assessment also. It gives us a very high-level guide. I can go to the sectoral risk assessment, and then I'll go through some internet resources to understand what is the risk arising, the terrorist financing risk arising in Cuttack from these elements. So anyone so a person who is a customer who has migrated from Western Odisha, let's say, example, okay, by default, they'll be at a little bit higher risk than anyone who is coming from Bhubaneswar or from any of the other coastal districts. Why? Because their exposure to the insurgency movement is more. Okay. Secondly, let us come to cybercrime. What is the risk of cybercrime? The threat of cybercrime all across the country is high. Mule accounts are being made all over the countries, all over the country. You can go to the website of I4C, Indian Cybercrime Coordination Center, in which a lot of points are mentioned. If you go to web resources, you'll realize that there are many mule accounts which are being opened all over the countries, including in hotspots in Odisha. So you should be aware about the risk of mule accounts, the risk of cybercrime happening from Odisha or happening in Cuttack. So that is one threat that you identify. Then number three is the threat of organized crime. Is the level of organized crime in Cuttack high or low? Is there at all any threat of organized crime? Are there mafia groups operating in Cuttack? I guess not. Then the fourth one is threat of narcotics financing. Okay, the other predicate offenses. narcotics financing, narco trafficking, a lot of seizures are being made from western Odisha, southern Odisha, and also from coastal Odisha, which means that the threat of narcotics is very high, which means that narco traffickers may be laundering their funds through your bank account, through you or through some cell companies which they have opened in your city. Next threat. Let's say a customer comes to you who is not an Indian. Okay, he's coming from he's a citizen of, let's say, China or Cambodia, some country. You try to understand, do you is there any threat from that country? Have you seen web resources? Have you seen any inputs? Have you seen in the NRA, in the confidential NRA, some countries have been mentioned as higher risk? Are these countries the same as those countries? Based on that, draw a conclusion as to whether that person presents higher risk or not. And but in generally, if someone is coming who is not from your country, if he's from another country, you need to have a better understanding of the customer. You need to know the customer much better. So naturally, a more enhanced their due diligence has to be conducted, right? So you mentioned them as a little bit higher risk. So that is how you document your whatever understanding of risk that you have. That is what is called risk assessment.
So the next question is, so what are the major area need to look and how to be more detailed on AML and FATCA related areas? I hope I pronounced it well.
Yes, you have pronounced it well. Regarding FATCA and CRS, they are being managed by the Income Tax Department in India. And on FATCA, it is not appropriate for us because we are not the experts on FATCA to give you any strong feedback. With regard to your AML CFT risks, I will tell you that the risk of cell companies is quite high. And the problem is that nowadays what is happening is, not nowadays, always what has been happening, this is a trend in India or in many other countries, is that at the time of creation of a company, we do not usually know whether that company is a cell company or not. Technically speaking, every company at the time of incorporation is a cell company, right? Okay. So whether it becomes a cell company or not, that you get to know after it is incorporated, after transactions happen, by looking at the conduct of that company. However, there are some red flags which you can identify at the time of incorporation of a company. Why does this person want to incorporate 8 companies or 9 companies? Who is this person? What has he been doing? What is his background? And why does he want to incorporate companies? It is not easy to run a company. It is not easy to manage a company, maintain a company, because every year you need to get the company's accounts audited and you need to get its income tax return filed. So there is some compliance burden anyways on companies. Why does this person want to start some companies? And does he want to start one company or 2 companies or multiple companies in a bunch? Uh, which is the address in which this person is trying to incorporate a company? Does this address look suspicious? Does it appear suspicious? Who are the shareholders of this company? Are they suspicious by any chance? Are the directors different from the shareholders? Who are the shareholders and who are the directors? What is the source of funds? If in the MOA or the AOA they mention that we want to do so and so activities, do they have the credibility to engage in those activities? These are some of the questions that you have to ask. Okay. In the case of cell companies, why? Because that is the only way you can identify that this person may be incorporating a cell company. The problem is that once a cell company is incorporated, only after that the company can be used to layer funds or to move funds around, dirty funds around. But whenever it is caught, whenever law enforcement authorities start investigating the issue, they start making inquiries with the professional also who has incorporated the company. It is but natural for them to do so. So that's the reason why whenever you're incorporating a company, you have to make some checks and you need to document whatever checks you have done. Okay, so that is simple advice that I can give you, personal advice that I can give anyone. Uh, uh, that is on with regard to companies, and then with regard to trusts. Okay, there are public trusts and there are private trusts. Whenever anyone is opening private trust, what is the need for opening a private trust? What are they trying to do? Are they trying to manage any property? Are they trying to hide a property? Is the settler trying to manage, trying to open a trust so as to ensure that any liability on the settler does not fall on the trust? What are the terms of the trust? Who are the beneficiaries of the trust? Are they related to the settler, or are they completely independent? Is there any long-term objective that you see in the settler trying to incorporate this trust? Similarly, in the case of societies, is it a multi-state cooperative society? Is it a simple cooperative society? What is the reason for opening this society? Is this society being opened as a cooperative society so as to perform some kind of an activity, or is the intent to engage in finance activity, to raise funds, to raise donations, to raise deposits? Okay, if the intent is to raise deposits, then there's a probability that then there's a risk of some degree of risk of there being a violation of Birth Act or Price Cheats and Money Circulation Schemes Act. Okay, so there is some degree of risk that you see here. Then next thing is, let's say some company is being incorporated or some company is being formed or some restructuring is happening with an intent of doing some brokerage work in the share market or doing some trading in the share market. Who are the beneficial owners? The person who comes to you, meets you, and says that he wants to start a company, is he the same person whose name is there as the beneficial owner? Is the ownership structure too complex? Who are the shareholders of this company? Are the shareholders direct owners of the company, or are they working on behalf of someone? Are they is one of the owners a cook of some a businessman or the driver of some businessman? Is the owner a company, again a company? If the owner is a company, who is the owner of that company? Is it again a company? Is there a complex ownership structure? These are some of the questions that you can. These are some of the red flags. Okay, which will come to you when you do a risk assessment, and when your associate, when your institute also does a risk assessment, because ICAI will also be involved in developing a risk assessment. So these are some of the issues that will come to you. Next, some very simple issues. Are there any transactions which are curious transactions happening between your company and a company that you are managing, and a company based in Mauritius or Dubai? Let's say I'm not singling out any country. Let's say some offshore finance centers or tax havens. There is some transaction that is happening with some companies in those countries. Why is that happening? What is the purpose of the transaction? Is the purpose clear to you? Is there a clear business rationale? If there's no clear business rationale, why is there no clear business rationale? These are the questions. I asked you, I told us these questions. But when you start doing this exercise, in your case, it will be much easier once you get the SRA and once you get access to the abridged version of the NRA. You can do this exercise in a matter of 2 days or 3 days. You develop your own risk understanding, and after that, you just revise your risk understanding. That is how you improve on the risk assessment that you have done. And there are some red flag indicators that you should keep in mind.
Okay. So next question is by Aditya Khare. In some suspicious cases, it is experienced that personal information, detail of clients are not available due to secrecy and confidentiality clause of agreement entered between different institutions. Given these limitations, how to proceed further on investigations and filing of STR to FIU? With how many countries government of India entered treaty or MOUs on AML and CFT, where those MOU can be referred for use and referral in screening client transactions?
Yes, the multiple questions. I'll go through them one by one. As regards the first question, if there are secrecy conditions, okay. Now those secrecy conditions can be overridden by a law of the country. Okay. Now, KYC has to be collected by you. Okay, that is a mandate given to you by your institute, by ICAI. It's a requirement of ICAI. It is a direction of ICAI, and ICAI gives this direction because of the statutory mandate under ICAI Act of the MCA, Ministry of Corporate Affairs. Okay, so there is a statutory mandate on you to breach this corporate this well and find out the beneficial owners. In PMLA also, if you look at PMLA, it is mentioned that KYC process should include and details of the beneficial owners. Details of the beneficial owners should be collected. So you are actually protected by law here. Okay, you can always say you can always say that I understand that there are some secrecy conditions, but my problem is that as per Indian law, I need to at least have a look at it. I will not pass it on because of secrecy reasons. I'll also be I'm also taking an oath of secrecy. I'm not going to share these details with anyone else, but I need to keep a record of the client that I'm dealing with. Okay, I can assure you of the secrecy that I'll be maintaining because of the agreement. However, I need the details of the client that I'm dealing with, and this is a requirement under the law, and that's the reason why I would request you to give me the details. That is the first thing. Okay. Second thing is as regards filing STRs. Unfortunately or fortunately, you do not have to file STR in every situation. There's no need to file STR in every situation. STR has to be filed only when you are conducting financial transaction for or on behalf of a client, because STR means suspicious transaction report. Only when a suspicious transaction has happened through you, or a suspicious transaction has been attempted to have through you, you have to file STR. In any other situation, if you want to file STR, you are welcome to do that. In fact, it is good. If you see something suspicious, okay, let's say you find a client very suspicious, you say that no, you cannot take that person as a client. Immediately you can file a STR, and FIU will take cognizance of that STR, and then it will start making use of this intelligence. Okay, so it is a suspicious activity, not a suspicious transaction. But still, you can file a STR, because it has been filed, FI will obviously look at it more closely and with the same degree of seriousness. However, there is no mandate on you to file STR if there is no suspicious, if there is no transaction that has happened. A transaction has to be happened, and it has to happen through you. For you have to do the transaction for on behalf of the client. Only then you have to file STR. Otherwise, there is no mandate on you to file the STR. So that clarifies the second point. If a suspicion arises, you ask for more documents. If they do not provide the documents, you tell them, look, because I find you risk, because as per my risk policy, as per my risk assessment, you have been tagged as high risk. I need to collect these documents and keep it with me. Okay, I'm sorry if you are unable to give those details, then I cannot do anything about it. And if they give those details, you read those details in greater detail, you maintain a documentation that you had found so and so things suspicious. They have given you those details, you have checked those details, and now you are satisfied that it is a genuine client. Okay, and if you're not satisfied that it is a genuine client, of course, because under MCA rules, you have to make a signature, you have to give a verification, you have to satisfy yourself. Naturally, you're not satisfied, so you will not go ahead with the transaction, with opening the company, or with engaging in that activity, and you will refuse to the client. You'll give a refusal to the client. I think the second question that you asked, I have not taken note. Rekha madam, do you remember that the second question?
With how many countries Government of India has entered the treaty or MOUs on AML and CFT, where those MOU can be referred for use and a referral in screening client transactions?
Okay. So we have entered into a MOU with 96 countries till now. Those are MOUs or FIU to FIU MOU. MOU for coordination and cooperation between FIUs. So if you so screening of client transactions, it works in this way. Let's say in the case of a client, you find that the client is not disclosing the beneficial ownership to you, or it is not they're not disclosing some detail which is required as part of the KYC process. You can always send that information to FIU of India, and FIU of India will ask the FIU of the other country for those details. So the FIU of the other country will ask the ask the subjects in that country and retrieve their information and give it to FIU of India. So these are 96 countries. All the major economies are covered.
Okay. The next question is by Subhanshu Gupta. We take KYC of directors and shareholders. What is the point of obtaining these documents?
Yes, very good, very basic, but it's a very important question. At the same time, one of the basic questions that should be answered. See, these KYCs are taken, and in PML, under PMLA, Prevention of Money Laundering law, there is a set of rules called PML Maintenance of Records rules. You take these details KYC and then you maintain them for 5 years. After 5 years, to destroy them. Okay, why you need to maintain them for 5 years is this, because it shows that you have done your due diligence and you have maintained the records for that. Tomorrow, let's say that person, that client engages in fraud or engages in money laundering or engages in narco trafficking. Tomorrow, a lot of LEAs are going to come after him. When the LEAs come after that person, the first thing they will do is that they'll make inquiries with you. When they make inquiries with you, you can always support the LEA. You can help the LEA by giving them these KYC records. That is the first thing. You can give them the KYC records. By doing that, you are actually helping the LEA. Okay. FATF sees you as part of the process. They see public-private collaboration as an important process of the law enforcement process, as an important part of the law enforcement process. So whenever you do something like this, you are actually partnering with the LEA. That is the first thing. Second thing is, because you have collected all these details, it demonstrates that you have done your due diligence. You have done your activities professionally and to the best of your ability as per in compliance with the money laundering law. And that's and showing those records that you have maintained the appropriate records is an evidence of that.
Sir, all questions are answered. I request all the participants to just put their questions. So they are invited. So there is a question of mine. Recent case, there was a Mahadev app laundering. Sir, what should we check about? With respect to that, what should CA check? Like first, how the CA involved in this and how the CA would take this consideration कि ये मुझे देखना चाहिए था पहले. I have to check all this thing and then proceed. So how we just what is the first step you just see कि ये देखना चाहिए था और जो skip हो गया?
See, because it is a live, it is because Mahadev case is a live case. Okay,
Yes.
it's an active investigation going on. I cannot engage with you on that case, but
No,
generally,
I'm just taking it as an example. Yeah.
Generally, let me talk about online gaming cases, for example. Let's talk about online gaming. Okay. So
Yes,
randomly, let's pick an online gaming company. It's actually a gambling company. Okay.
yes,
Now
sir.
we know that under the game of chance or the gambling, it comes under the state law. Okay. Whereas game of skill, which is gaming, it comes under the central jurisdiction of the center. All the states have banned gambling, but in spite of that, illegal gambling happens in many states. Okay, there are dens in which illegal gambling happens. So this is one of the questions that you ask as part of the risk assessment. Does illegal gambling happen in Cuttack? Does illegal gambling happen in Odisha? The answer is probably physical gambling happens or doesn't happen. I don't know. You have to find that out. But online gambling does happen. Okay, the number of online gambling companies has increased manifold in the last few years. We see an increasing trend of online gambling companies operating. Now, how can online gambling companies operate in my state or in my country when it is banned across the board? It is not banned in Goa, but you can do gambling on the sea after taking a license, not on the land. Similarly, you can do gambling on some specific places in Sikkim after taking a license. Okay, but unregulated gambling is not allowed in India. It is banned in India, but still online gambling is happening in India. Why is it happening? That is the first question that you can ask to develop an understanding of the risk. Okay, it is happening because online gambling happens overseas. All the companies, the companies ownership and structure and the activities, they're based outside India. They're coming to India only to hook onto victims, only to hook onto clients and get their money. So which means that when they're operating in India, they're operating illegally. The entire activity is illegal, and the entire activity and the money taken in this activity, any gain in this activity, is a proceeds of crime. So they are generally high risk. Now the second question is, if online gambling is happening in India, how are they collecting funds from people? Naturally, they're not going to the doorstep to collect cash. They are collecting funds from the people through some merchant ID, right? They're getting the merchant ID of some online, fintech company, and through that they're collecting the funds. How are they collecting the funds from the people in India? You do some basic googling, you'll get to know that they're collecting it through some merchant ID or by creating a front company, which is or by creating a front NBFC. Okay, you try to have a basic understanding of the modus operandi. The modus operandi involves mule accounts, front companies, and NBFCs. Okay, they will purchase some NBFC, and suddenly there's a lot of activity in that NBFC, whereas earlier there was no activity in that NBFC. Okay. Now, what kind of risk can come to you as a chartered accountant? Let's say someone arbitrarily comes to you and says that I want to purchase an NBFC. Okay, and I have got a person who is ready to sell me that NBFC. I want to acquire the NBFC. How do I acquire that NBFC? Okay, so you ask this question. Oh, so you want to acquire this NBFC? What has this NBFC been doing? Naturally, that NBFC was a dormant NBFC which this client is acquiring. Okay, so you'll acquire this dormant NBFC, and then what will you do? So the NBFC has a license from, let's say, RBI or NABARD. Are you going to intimate RBI about it? What kind of intimation are you going to give to RBI about it? Then maybe this person will go backtrack. He will say, okay, I'll not purchase it, but I want to do an MOU with the NBFC by which I'll be able to operate that NBFC, which means that he wants to take control of that NBFC. Giving you some examples. Next thing is that some person comes to you and says that I have a company and the company is operating very well, but I need to send some money outside India. Someone has provided me consultancy. Let's say, Salman, let's say Smarak Gaming Limited is a company based in Malta. Okay, that company has given me a lot of intellectual properties, IP, or it has given me some software codes which I'm using to do some play some games. I want to provide them a consultancy charge. I want to give them a consultancy payment which is outside India. You please help me fill up the formalities for AD Bank, authorized dealer bank, right? You please help me go through the FEMA procedure because FEMA is so complex. You please help me go through the FEMA procedure and repatriate money back to Malta. That should raise eyebrows. Why does he want to send money outside India? Is there a past to this? Has he been conducting this kind of activity earlier also? What is this company doing? Suddenly this company has come, it does not have any background in export-import or in providing consultancy to foreign companies. Now suddenly it is coming and says that it was to send money to a foreign company in the form of royalty or consultancy payments. It wants your help to fulfill all the formalities or the documentation for that. That will raise eyebrows. Now, this is how you do things, and you have asked a very pertinent question. The answer to that lies in conducting the risk assessment. When you conduct the risk assessment, naturally you will go in a very systematic way in understanding what is the risk arising from offshore gambling companies and how I can identify those customers, those potential customers who may be involved in dissipating the money arising from offshore gambling.
So do you think CA have a mandatory role in risk assessment exercise at the organization level, especially for non-financial entities?
At an organizational level, doing an assessment of the risk of that entity, it's a very good question that you asked. For all the financial institutions, okay, financial institutions includes banks, insurance companies, stockbroking companies, any kind of intermediaries which are into in financial businesses. They need to conduct their risk assessment, and many times they rely on some of these charter CA companies, consultancy companies for developing their own risk assessment because you understand financial risk better than them. Okay, so they rely on you. They may also hire you to conduct their own risk assessment. For example, now we are developing the NRA 2025. After that, you will see that RBI will develop its own SRA. After RBI develops its SRA, all the banks, all the insurance companies, all the entire ecosystem of banking companies, or even NBFCs, they are going to develop their institutional risk assessment. At that time, they may seek your support. They may hire you as consultant in developing their IRA, their institutional risk assessment. I know for a fact that PwC, Deloitte, they do provide consultancies to in developing the risk assessment of financial companies. Now, your second question is, especially in the case of non-financial companies. In the case of non-financial companies, the requirement of doing a risk assessment, AML CFT risk assessment, lies only on a limited number of companies. These are mostly real estate agents, okay, casinos, gaming companies. As of now, explicitly gaming companies are not mentioned, only casinos are mentioned. So if there's any online gaming company which is in the nature of casino and identifies themselves as casino, they need to conduct their own internal risk assessment. In the case of other companies, they may or may not conduct their risk assessment. Even if there is no law, there are some gaming companies which actually conduct their MLTF risk assessment. For doing that, they may seek the help of chartered accountants. Okay. Other than them, there are obviously professionals, and then there are trust and company service providers, TCSPs. In their case, also they need to conduct risk assessments, and they may seek the help of a chartered accountant. Also, crypto exchanges. Crypto exchanges, they have to conduct a detailed risk assessment of the risk that they are facing from money laundering and terrorist financing risk that they are facing, and they may seek the help of chartered accountants as consultants in this regard.
Okay. Sir, what is the basic thing that in this field you see as a CA we skip? Like basic चीज था वो छूट गया. Although we are in a major transaction, we are screening or everything we are screening, but sometimes it happens na, that little things or a red flags that especially CA often tend to overlook while dealing with the clients.
That CS would be much better able to say than me. Okay, but if you ask me from the other side, I mean, what I have seen from investigation results and from case studies,
yes,
it is basically informal nominee relationships. Okay, informal nominee relationships. Whenever we ask for beneficial ownership, we ask for beneficial ownership by actual voting share. Let's say a company is being incorporated. You try to understand who is trying to control this company by through ownership, but we do not try to see who is trying to control the company without having any ownership in the company. That is where some real risk lies, which CS tend to overlook. That is called ownership by control. Okay, BO. That is called BO by control. You do not own it, but you control it. In India, colloquially we call it benami. But internationally, there's a jargon for it. It is called informal nominee relationships. So the actual person who is controlling a company or who is controlling the activity or controlling the transaction, that person does not come in front of you. Or maybe that person comes in front of you, but the company's directors, shareholders, they are completely different. And you realize that these are all benamis. They are nominees of this person, and this person has not declared them as nominees. So they are informal nominees. So that is something I have seen many times being missed out by chartered accountants. Chartered accountants not asking that question to people, not asking the right questions or the hard questions about how this person is related to these people. And this is especially relevant in the case of politically exposed persons, PEP. The standard for PEP is mentioned in recommendation 12 of FATF. That also has to be followed by you. Okay, if you find that a politically exposed person is somehow connected with a company which you are going to form, the risk automatically increases manifold. You need to be more, and by PEP, I don't mean only politicians. I also mean senior officials in government of India, in state governments. Those are included in the definition of PEP, politically exposed persons, PEP. Especially in the case of PEP, if you find informal nominee relationships, that raises a lot of red flags. But many times we just overlook that.
Okay. So can you share please your key learnings or challenges that you faced in your journey while working on this national or international level?
I'll tell you. I won't say what challenges that I faced. I'll say what challenges that we as a team faced, because our national risk assessment happened in 2022, the last one, and immediately after that in 2023, our mutual evaluation process started. Now, mutual evaluation is a huge process. It's a significant process in which a lot of scouting happens, a lot of domestic resources are mobilized so as to demonstrate to FATF, to our peers who come to audit India, because it is a it's a peer review, right? Mutual evaluation is a peer review. So those who come to audit India, to demonstrate to them how effective we are. In India, we are a very well regulated country, okay, and we are very effective also, and also we are very eloquent and articulate about explaining what we are doing, okay. So ideally, it's not having much of a problem, but it still was a major challenge because of the nature of the methodology that FATF uses. Because the methodology is so detailed, we had to do a high degree of coordination with all the with about 30-35 departments of the government of India, and with all the states of the government with the state of India, to get the information, to collate the information and put them in an organized way so that we can tell a story. We can make a narrative. We can develop a narrative and tell it to the assessors. That is something which was very challenging for us, and we managed to do it. More importantly, my biggest learning was that uh, uh, public-private cooperation is the future. Public-private cooperation is how you can actually demonstrate maturity of a system. Uh, when the FATF team came to India for assessment, they interacted with the private sector in India. They interviewed many members of the private sector, including members of ICAI, ICSI, and also many professional chartered accountants. They were very happy on learning our understanding of risk, the understanding of risk of our private sector. They also acknowledge that public-private cooperation happens at a very advanced level, at a very deep level in India. And that is actually the future, because when public sector and private sector they start working together, a lot of synergy benefits come out of there. The public sector never goes overboard. The regulation is not never over the regulation is never over. We don't resort to over regulation. At the same time, we get very good fillers and very good inputs from the private sector, due to which the public sector can be proactive in coming up with new regulations, appropriate regulations, and balanced regulations. Uh, and that has been, I would say, my journey till now here.
Okay. So there are questions by the participant. How AML and FATF become important in NBFC environment in Indian context?
Uh, RBI is in the process of developing a sectoral risk assessment of NBFCs. Of course, what they do and what they find out, that will be shared with ICI also. But very briefly, I will tell you. NBFCs in India, there are significant number of NBFCs in India. Some of the NBFCs, like for example, Bajaj Insurance, Bajaj Alliance, to give an example, they are all big NBFCs. They are huge NBFCs in India. At the same time, there are many NBFCs which are very small NBFCs. All the bigger NBFCs, they have very good AML CFT controls. But once we come down to the smaller NBFCs, we need to see that because they're smaller NBFCs, they can their compliance burden should not be very high. Okay, they are also having good AML safety compliance. They are also doing KYC, but we have to ensure that the KYC process the compliance cost is low. If the compliance cost is low, then the compliance efforts of the smaller NBFCs will definitely be much better. As of now, what RBI is doing is that RBI is following a risk-based approach for the larger NBFCs. But for smaller NBFCs, they are still not following a risk-based approach. Step by step, they're going down to smaller and smaller NBFCs in following risk-based approach. In the case of very small NBFCs, on-site cannot happen more frequently by the regulator, by RBI, for example, in the case of NBFCs. So for very smaller companies, especially in the case of very small NBFCs, self-regulation is more important. Okay, and that's the reason why reducing compliance cost is also very important. If we keep the compliance cost reduced, if we keep the KYC process simpler, the adoption of AML CFT will be much better for those NBFCs. That is one. That is one learning that we have had from a policy point of view with regard to NBFCs.
So the next question is, suspicious transaction 23 suspicious transaction reporting in connection with the increase in online frauds where bank account were used to receive and transfer proceed of crime to many accounts to erase the source of fund. RBI had commented that agencies responsible to report suspicious transaction have failed to do so. As a branch auditor, how can suspicious transaction be detected within a short period of time available?
Okay. So now you are not asking this question as a reporting entity, not as a reporting entity, but as an auditor. Okay. I'll tell you what happens in a bank. Okay. Generally, in a bank, what happens is, okay, they have a transaction monitoring system. The branch manager obviously does not have that high degree of understanding of suspicious transactions. So the branch manager generally engages in the transaction. There are some red flag indicators which are given to the branch manager. Okay. So the branch manager checks those red flag indicators. Okay. Uh, in most of the banks on today's date, it is digitized also. What happens is that the red flag indicators are given by FIU, and there's a huge set of red flag indicators which have been given. The bank manager usually does not understand these things. They cannot implement those things. So what happens is that they rely on software. So they have some inbuilt software, in-house software, in which these red flag indicators have been integrated. Based on these red flag indicators, alerts are generated. Like in the case of SBI, alerts will be generated in any branch, let's say in the branch in Delhi. After the alerts are generated, all the alerts move to a centralized office in Jaipur, the Jaipur in Rajasthan, where these alerts are analyzed to see if they are actually correct alerts or incorrect alerts. So false positives are removed, and only the alerts which point towards real suspicion, they are taken and then they are developed into STRs, and then STRs are filed. This is the process that is being followed. Now, when you are doing a branch audit, the first thing that you should ask, if something like this has happened, is you ask the branch manager, you please show me what is the alert generation process, what is the transaction monitoring process. You will say this software does the transaction monitoring. Then you ask him how many RFIs have been provided by FIU, and have all the RFIs been integrated into the software. Okay, if they have not been integrated, which of them have been integrated? In some bank branches, I won't take the name of banks. What has been seen is that they do use a software, but within the software, there are some very simple algorithms, one or two simple algorithms, such as cash withdrawal above 10 lakh rupees. Whereas the real red flag indicators are not included in those software, due to which transaction monitoring actually does not happen properly. So you can catch that if you do a system audit.
So the next question is, according to you, what are the top 5 risks that may arise due to ML and FT?
That is a little a difficult question to answer. But see, if you say according to me, because I am part of the team that develops the national risk assessment, what I'll be saying will be at a very top level, at the national level. Now, top 5 risk, obviously the first one will be cybercrime, because as per one estimate, 0.7% of India's GDP is lost in the form of cybercrime. You think about all those people all over the countries who are losing money because of cybercrime. In India, mule accounts are being available for sale. So mule as a service, MAS, is a reality in India, as also in many other countries. We have seen this happen. We have seen money lost in cybercrime in Singapore, in Canada, in Australia, in Indonesia, in all countries. It is an issue in all the countries. while India loses 0.7% of its GDP in the form of cybercrime, okay, Cambodia gains almost 25% of its GDP by doing cybercrime. It's not that Cambodia does cybercrime, but there are criminal groups in Cambodia which run call centers, which gain all of this money, which is being lost in other countries. So 25% of the GDP of Cambodia, it is estimated, comes from cybercrime. Okay, so that's the reason why cybercrime is high risk, extremely high risk. Number one. Number two will be other kinds of frauds. There are bank frauds, there are Ponzi schemes, there are investment schemes, which keep propping up all the time. So they also present high risk. According to me, they are number two risk. Number three risk is terrorist financing because of the severity. The quantity and quantum of terrorist financing may not be very high, but because of the severe consequences, I consider them high risk, extremely high risk. Number four is narco trafficking. We have seen the number of seizures of narcotic drugs increasing manifold in the last few years, especially in the border states of Northeast India and also in Punjab. We have seen the seizures increase in Maharashtra. We have seen seizures increase even in Odisha. There is a spike in seizures, and we also see the involvement of criminal syndicates or criminal groups which are actually managing these peddlers. Now, if the criminal groups which are involved, obviously they are the ones which are getting which are running the trafficking networks and which are getting landfall profits, because you do not get as much profit in any other business as you get in narcotics, in narco trafficking, and the consequences of narco trafficking is also significantly high. The fifth one, if you ask me, it is basically also undisclosed foreign income, undisclosed income, which can be in India also or in foreign also. Mostly the risk arises from foreign undisclosed incomes, income which has been earned by Indian residents but hidden in foreign bank accounts, and resultantly round tripping as well. So these are the five risks that I consider to be the top five risks.
Okay. So the next question is, um, we have many clients from financial sector, but they generally obtain KYC as a part of AML guidelines by RBI, and further processing of any form is not done by them. Since no detailed information over it is present, what shall they focus on while obtaining KYC, and how shall they be more vigilant towards intent of AML guidelines by government? In continuation, what issue you would like to highlight which you faced while dealing such cases?
Mhm. So again, I come back to what I had explained earlier, the risk-based approach. So if a client is giving some basic details to RBI, it's sorry, to a bank, okay, you collect the same details. You don't have to collect anything extra. So that same details you collect, you keep it with you and you maintain a record of it. However, if you think that the customer is high risk, if you perceive the customer to be high risk, or based on your risk assessment, if you, as per your risk assessment matrix, you think that this customer is actually for presenting high risk, you do not go by whatever documentation they have given to the bank. Okay, you ask them for more documentation. Now, how much more documentation is to be asked, that you will yourself understand after you do the risk assessment, because I can only explain that using some examples. Like, for example, if you, as part of the risk assessment, you have understood that this guy can be a mule account. This can be a mule account. If you understand that, okay, you will ask for, or this guy can be a mule for someone else who has come to me to open a company, or to operate a company and open a bank account. You can ask him more questions about his background, which the bank has failed to ask. For example, what is your educational qualification? What have you been doing till now? What are you doing now? Okay, so fine, you want to open up a company, and what will you do with this company? Uh, are you working for someone else, or are you working of your own volition? What kind of resources do you have to, based on which you are saying that you want to move this kind of money? I see that in the balance sheet, there's so much of funds which are maintained. What is the source of these funds? What kind of business did you do based on which you are getting these funds? These are the questions that you can directly ask them. You can ask them for documentation that can help them explain their point of view. This I think this is what has to be done only, enhanced. your due diligence has to be enhanced. And how enhanced that due diligence has to be, you as a professional know it very well. Only thing is that we give you a structure that you have to do an enhanced due diligence. You know very well what are the questions to be asked. Yeah.
Sir, all questions were answered.
Okay. So there are quite a few questions, but I like the questions that were asked.
Okay. So before conclude, I just want to ask you what is the most important thing that we as a CA should always keep in mind when it comes to AML and audit?
Okay. Okay. The most important thing that you need to keep in mind, I would say, vigilance. You have to be vigilant, and for being vigilant, uh, uh, you must have met some chartered accountants who are more vigilant than other chartered accountants. There'll be some chartered accountants who read the paper on a daily basis, who meet a lot of clients, who go through a lot of records, who do a lot of audits. So their understanding is much more advanced than the understanding of other chartered accountants. Why is that so? Because they have learned a lot of things on the go, which others have not cared to do. So in a structured way, if you try to do a risk understanding, if you try to develop a risk understanding, which we are calling a risk assessment, if you try to develop a risk understanding, all chartered accountants can be at the same level of understanding. And that is what is basically required. So if you have that understanding of risk, you can immediately catch a transaction. If something fishy is happening, you can immediately say, okay, so this is happening because of so and so reason. If someone is approaching you and saying that, look, I want to start a company, or sorry, I want to start a cooperative society in which I'll be taking deposits from people and giving them land. Okay, because you have done a risk assessment, you have understood what are the risk, what are the various risks. Okay, you have an inkling that this may be a Ponzi scheme, or this may be an investment fraud. Okay, so once you get that inkling or get that suspicion, to to get that suspicion out of your mind, you'll ask a lot more questions. You'll ask for a lot more documentation. That way, you are also keeping yourself safe. You are also keeping your client safe. Your client, you're keeping your professional boundaries safe. And if the client is actually a bad client, you manage to escape that client, because a bad client always, when they go down, they always take their charter accountants down with them. They may take no one else down with them. They will not take the bank manager down with them. They will not take the employees down with them. When a bad client, when a criminal client goes down, they take along only one person with them. That is the chartered accountant.
Okay. Okay. Sir, all questions are answered. Everything is done. Thank you so much, Sir Agam sir, for sharing your deep insight and practical knowledge on such a critical subject. We are truly grateful for your time and guidance. On behalf of all participants, thank you once again. And there were more than 450 participants.
Thank you.
Yeah. Thank you. Thank you so much, sir. Mayank, sir? Technical team?